Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today's episode features insights from the recent AICPA Conference on current SEC and PCAOB developments, an important gathering of the year for those tracking the evolving landscape of accounting, auditing, and financial reporting. The conference is known for surfacing timely and often forward-looking updates on everything from standard setting and enforcement trends to the regulatory outlook to developments in emerging areas. Hosting today's discussion is Kyle Moffett, a partner in PwC's National Office. He's joined by Scott Feely and Kevin Vaughn, also partners in our National Office. Let's turn to their conversation and hear what stood out from this year's conference and what it could mean for you and your company.
Scott and Kevin, thank you for joining us today. You both just attended the AICPA Conference in Washington, D.C., along with me. I actually had the pleasure of being the chair of the AICPA Conference Planning Committee. And I've certainly heard a lot of complaints about, the donuts weren't good enough, or they weren't provided long enough, or where was the bacon? We had eggs, but where was the bacon? So there's a lot, obviously, that happened at the conference.
Fair questions.
Very fair questions, obviously.
More than meals, though.
more than definitely true. Scott, can you provide us a little background on the conference, the various presenters? Kevin, obviously, you were also previously at the SEC, but you're at the conference. Any perspectives you guys have to share?
Sure. Yeah, maybe I'll go ahead and I'll get us started. So, it's just a really popular, well-attended annual conference. I've heard people describe it in the past as the Super Bowl for accountants. So if you like this type of stuff, it's a pretty big event. It's three days, presentations from regulators, standard setters, and various other parties in what I'll broadly call the financial reporting and regulatory ecosystem. So that includes audit firms with a heavy presence from their national offices, certainly preparers, security lawyers, academics, financial analysts, economists, lawyers, et cetera. But really, when you take a step back, it's a really good opportunity in a lot of instances to hear directly from regulators going into year end what they're seeing, and what registrants ought to be focused on going into their closing cycles. So that's really what it's about. It's a pretty exhausting conference.
I would say so. Yeah.
3 days sitting around listening to some pretty heavy content, but
and I think, and we'll get into it a little bit more, but the SEC chair came and spoke, and he was kind of the keynote. So good work, Kyle, and setting that up. And it's good, right? It speaks to the importance of the event. It speaks to it also, right? It was good to hear him talk about the importance of the profession and clearly hear that that's top of mind. And we haven't. It's not always a guarantee that the SEC chair can come, and certainly have not seen the chair there in recent years, but it was certainly good to have Chair Atkins there, and I think maybe if I think back to like the podcast last year and some of the discussions last year, right, it was a lot of good content, of good variety of content, but I think in prior years, maybe sometimes there can be more drama than others. I was actually somewhat relieved. This year, there wasn't a whole lot of drama, right? Like in terms of the messaging, like, right. It was all things fairly consistent what we heard, certainly some nuggets that we'll get into, some additional nuggets. And so it was really good. So again, Kyle, great job. The committee, I know that it's a whole committee, right?
Yeah.
And I know you say that too, but, but I guess maybe along that line, because you did have, like, as you guys were thinking about the conference, right? Like as you were thinking about, right, there's some standard sessions, but you also fill in a lot of others. And I think it was a good diversity of perspectives and of topics. So I guess what was your thought? How would you self-assess?
Look, you always, there's always challenges, right? And to your point, there are kind of the staples, right? The people that you typically get. And I think this year, we didn't get the enforcement division. but then we wound up getting a former chief accountant of the Division of Enforcement and 3 lawyers that actually are in that space, and so they're sharing their observations. I thought that was really interesting, kind of the way that they presented information, where they thought things would head with this commission versus the prior commission. They actually had a list of cases that were brought in the prior regimes, and kind of said, well, would this action be brought today? Where would this land? And so they kind of were showing that, highlighting the difference between the two administrations. And I think the thing that stood out to me, obviously, was there was more engagement from the SEC than in prior years, which I think, like you said, the chair being there, Kurt Hall having the keynote, spending time, and it was not a speech, it was the willingness to sit and have a conversation, have a dialogue, the fireside chat approach. I think it was very well received, and I think that's to your point about the various types of programs or panels, wanting people to come away from the conference thinking, okay, I've learned some things that are somewhat outside of my normal everyday, but it informs me, can now engage with, my chief accounting officer, my controller, my, CFO, my CEO. I understand the challenges they face in running the business. I understand shareholder activism, which you heard a lot about, AI, and I know you guys will talk about that. But I think I was very pleased with it. And obviously you get a lot of complaints, as I said. I'm surprised I can still talk after 3.5 days of being kind of floating around since Sunday through even today.
The mayor of the AICPA Conference.
I mean, it is a lot. It's a lot of work, right? And so you're definitely, you're up on stage, so you tend to, you're kind of, kissing baby, shaking hands. And so it's pretty exhausting, to your point, right? And so this is the culmination. So after today, I think all 3 of us will be happy to head home for the weekend and relax a little bit.
No doubt.
So look, I think the one thing I'd say as I think about kind of the conference and the benefit of going or listening or watching it virtually is I always feel enlightened after hearing directly from the source. And so you always want to know what's top of mind at the SEC, the PCAOB, and the FASB. And I think starting even with the first day when, Chairman Paul Atkins spoke, one of the regulatory themes was, and what he said, and we even saw it in I think it was a meeting they had with the New York Stock Exchange, making IPOs great again. So Scott, can you share a little bit about what you gleaned from that
Sure.
part of the conference?
Yeah, I guess there was no real surprise, as you allude to. He's used that tagline in numerous forums that preceded this one. So it's this administration and commission has been pretty clear about their intent to focus on facilitating capital formation. So he got us kicked off early on day one, and sort of laid out this tagline, and then maybe lamented a little bit the fact that the number of public registrants in the United States has declined pretty substantially over the past 30 years, perhaps since he was last at the SEC. And while there's probably many reasons for that, some of which may be outside of the SEC's control, including the availability of private capital and things like this that have evolved in the intervening period, he did articulate a vision to attempt to address what the SEC could address in terms of making IPOs great again, by really anchoring it to 3 legs of a stool. So one, and most relevant for the financial reporting audience, I would say, was oriented towards what he characterized as the weight of disclosures. And you hear things along those lines, couched in various different ways. It might be cost benefit. He spoke a lot about materiality, and what disclosures are material, and really letting that inform what should be required in regulatory documents. I think he talked about separating the wheat from the chaff. And maybe that's really difficult for some investors to do today because of the volumes of disclosure that show up in typical registration statements. So he used things like risk factors as an anecdotal situation to illustrate this point, where he said when that rule first came out, maybe people envisaged that it would be a bulleted list, of a handful of risks that investors ought to focus on. And it evolved over time to be one of the largest, if not the largest section of a document, to the point where the SEC had to do rulemaking recently to, move in the direction of this bulleted
That was the
list,
first
right?
Trump term, right? Or it happened during the first Trump term.
Exactly. Yeah. So he used that to illustrate the point. He certainly alluded to other rulemaking that may make IPOs more attractive again, and we'll cover that in a little bit of detail later. There were two other legs. They're really better addressed by lawyers, but I'll just allude to them because it was part of his commentary. So he alluded to the rise of shareholder activism and the manner in which that interplays with the proxy process, and attempting to address that a little bit. And then, there was some discussion of, legal provisions that might have been included in registration statements with respect to, either mandatory arbitration or fee shifting and things like this. And he said, historically, the SEC would have
I remember those days.
Stop those IPOs, and they're going to move in the direction of relying more on state law.
Defer to state law.
Exactly, is what I heard from him on that topic.
Yeah. So. I mean, he seems to be he continues to double down on that commentary of, look, there's going to be a lot of deference to state law on a lot of topics. I think one thing that surprised me was not hearing much, at least on proxy advisory firms, and kind of the view from kind of that side of the aisle about, hey, do these proxy advisory firms have too much power, too much control over shareholder voting recommendations? And so I think, but we've obviously heard noise about, is this something that the White House might potentially focus on? So, but again, though, I think, as you think about kind of his commentary, obviously very interesting of where are we headed? Where are we headed from a regulatory perspective? And I think one thing that stood out to me, and it'd be interesting, Kevin, in your thoughts, but it sounded like he made a comment about, like, we're going to be doing this stuff. We're going to be pumping stuff out. Like we have a very short window. And so the message that I heard from him, and Kurt Hall, and even from Jim Maloney is it's going to be fast and furious. And so we can expect to see a lot of proposals coming out in the next few months. I think we're going to see some activity at the board of the PCAOB. So just broadly, right? And so it's, hey, they're fast and furious. You can have some proposals and adopt a bunch of rules. They're not going to adopt the rules right away, right? They're going to propose things. But I don't know, Kevin, anything that you wanted to add on kind of what you heard?
Yeah, no, I mean, I think that's exactly right. And we can probably get into a little bit later some of the specific rulemakings, but certainly, that is going to be the focus. I think we heard the words early in 2026. So not sure exactly the timing, but certainly I do think that when you think about the cycle of a rulemaking, that needing to get started on that, as soon as they can, and the shutdown didn't help them from that perspective.
And another shutdown may not help them either, right?
True.
And if that happens, then we're really in trouble, right? From an agenda perspective, capital formation perspective, at least when I say we're really in trouble, I mean from the perspective of issuers wanting action quickly, wanting to close out comment letters if they're, back and forth dialogue right now, if there's pre-clearances they want to get in, things of that. And then we'll get to that in a little bit. So another theme really was emerging issues, right? And I think we had heard last year there was a lot of feedback from the people that attended the sessions that there was too much of an emphasis on certain topics, and I won't mention what those topics are, but they were really looking more for, hey, can you do something, on other emerging areas, right? Like, let's understand what's going on with trade and tariffs. Let's bring back, an economist to really dive into what's going on. Can you, what about generative AI and where are we headed there? So, what can you share, Kevin, about some of those emerging issues that caught your attention?
Yeah. I mean, I think I'll start with that last one because you can't go anywhere without talking about AI, right? And I think it was, I would say, pervasive throughout almost pretty much every session. There was some sort of discussion about how that was impacting things, and a pretty broad range, right? It's just transforming. So we heard discussion about how it's impacting preparers, impacting auditors, impacting analysts and investors, et cetera. So, I guess I would maybe a few different versions of the commentary. One, talking about the risk associated with it. And so certainly we heard some of the SEC staff, right, thinking about the risk if you're going to bring it into your financial reporting process. I think Kurt Hall made made mention about like, hey, like is AI going to be used to prepare financials, prepare disclosures, right? But you still have to have controls and governance around that. The same internal controls requirements will apply regardless, right? And so how do you think about that? They shared some insights in terms of things that they think about in terms of thinking about that. We also heard it a little bit. We talked a little bit about risk factors. There's certainly one comment that was made by one of the panelists, and one of the panels was just the pervasiveness of companies disclosing risk factors on AI, and so that's not surprising, but certainly an area that companies are thinking about. And then on the accounting side, right, there's a lot of things in the news, a lot of different topics that can come up there, all some very unique structures that can arise there. And so the OCA staff talked about some of the consultations that they've dealt with there, that they've seen or thought about, right? And some of the issues that you think about there. It could be consolidation, right? Is it a VIE? And you kind of work through a waterfall. You might think about consolidation. You might need to think about leasing, whether there's embedded leases. And then there's also like fixed assets, like what's the useful life, and things like and impairment considerations. So kind of a broad range. I would say attacked AI from a lot of different angles.
Well, the one thing I'd kind of layer on there, and I think this actually was pleased about this, was the fact that the staff was willing to talk about generative AI and its use. And I think setting aside what you talk to companies today, they'll say, look, we're not using it much in the way of the financials, and you're putting it, disclosures in your footnotes. You're not seeing financial statement footnotes inclusive of all this generative AI. There's no real disclosures, but there are disclosures outside, right? Disclosures kind of throughout the filing. So, and certainly business description, like you said, risk factors. So I think it was definitely timely for them to talk about it. I think what I expect will happen next year is that, like ESG evolved into was a bigger thing, and then now it's not. I do envision that, in a situation that, hey, next year generative AI really is going to be, especially at the speed and the pace, it's going to be all throughout the agenda. And to your point, I want to echo, like, it was really felt. Anything else from other conversations and Chairman Atkins, things that he said that?
Yeah, I mean, another like thinking about emerging issues, right? And certainly Chairman Atkins, like what he's been focused on, right, is cryptocurrencies. And so that certainly was something they talked about it from the standpoint of rulemaking activity. And that would be in the population of those things that we expect to see coming in 2026. It came up some in the FASB discussion, right? They talked about some of their agenda, pulling both what they've done to date, and then also pulling in some of those things. And Kurt Hull talked about some of the interaction there and some of the focus there from an accounting perspective. Kurt actually made a comment, I think, that he thinks that the staff saved up all the accounting issues for when he got there. I think I'm sure when he got back to the office, they reminded him that they've been
working on this knee deep in this for years.
Knee deep in those accounting issues for a while. So they did address some specific accounting issues they've dealt with there around stable coins. And I like we had a podcast series, a number of different people spoke on a number of different crypto issues. I can't do it justice the way that they did. They were really actually, a number of people came up to me in the hallway at the conference, said, like, I loved, what you guys did on the crypto. So if you haven't listened to that, I think that's really gives you a good walkthrough in terms of a lot of the issues.
Absolutely.
and stable coins is one of the issues that I think is top of mind to a lot of people right now. So that's a good plug. I think it is evolving so quickly too that it's one where you look and say, hey, like generative AI in the crypto space, like every time I talk to our experts on crypto, whether it's Beth Paul, whether it's John Van Osdol in our national office, like it's evolving very quickly. There's always a new issue, a new consult, a new conversation with the other firms, the FASB, whatever. So I think it's one for people to not ignore
And I think, some people would like to ignore it just because they we're not going to go on that path. But I think like AI, you got to pay attention to these things. So we also heard a lot, and this was something I think we've already got some preview of this in various conversations and hearing and seeing speeches, some of the commentary from Chairman Atkins on international standards, right? From a sustainability perspective, certainly some commentary on that, his views on funding the IASB, right, and the financial statements, but then also the funding, split funding to the Sustainability Standards Board. So we've heard a lot of that commentary, but there were a lot of, I think, very interesting tidbits that I kind of gleaned from various individuals. And then I start to think about layering in, like, well, you also heard Kurt talk about it, right? Kurt Hall. And Kurt Hall is very, very knowledgeable on the international stage. And because he actually, as a retired EY partner, spent a number of years in Europe working on in the global firm of EY. So he does have a unique perspective. And of course, Commissioner Mark Ueda, he continues to have conversations. And so we know he's taken a role in coordinating a lot of the SEC's international coordination effort. So Scott, I know I said a lot there. Maybe I stole some of your talking points, but these were just kind of things that I noticed. What were some of the key themes you heard there?
Yeah, so I actually thought it was interesting. So as you know, I spent quite a bit of time overseas myself, and I might still be living overseas if we didn't think at some point IFRS was going to
That's true.
So
yep, that's right.
Back in 2008, when I repatriated, it was the talk of the town, right? We were all talking about possible convergence. The gap reconciliation for foreign private issuers had been recently eliminated, and so on and so forth. And we really haven't heard about it in any meaningful way in well over a decade. And so I'll come to the funding here in a second, but I did find it pretty interesting. And maybe to your point, it wasn't a one and done. It recurred, a few times throughout the conference, these themes around international, I'll call it collaboration, wasn't limited to accounting, right? So, it was both on the accounting side and also on the auditing side. So I don't know, for me, that was while we've heard, some of the concerns about funding, and again, I'll come to that, it was a bit of a change in direction with this focus on not seeking perfect convergence, but attempting to
leverage,
leverage each other's work and maybe eliminate differences where we can to make things.
I mean, we are this. I mean, the nature of business today, and obviously the administration, there are some changes, but the nature of the business today and the business work environment, a lot of our big clients, right, multinationals,
exactly,
right, and so we as a firm and the other firms are always they have an understanding of the international standard setting, what's going on, and the impacts for at least from an audit perspective, right? So I think those are great points.
Yeah, so that was all pretty interesting, and again, it went in many different directions. It was leveraging each other's work. It was maybe influencing each other's work, and sort of achieving convergence where you can, again, across auditing and accounting. I would caveat all of that with some of the concerns we've historically heard around funding and things like this. Those were
lived through before.
Yeah, those were certainly present. So Chairman Atkins as well as Kurt continued to highlight the dependence of the various international standard setters on stable funding. And Chairman Atkins even alluded to, his prior experience where he said, when the gap reconciliation requirement for foreign private issuers was eliminated, part of the thinking that sat underneath that elimination was that, the IASB was going to have a stable source of funding. And it's in this intervening period that the ISSB has emerged, and, some of the sources of funding have maybe had to be split. And, so the SEC has expressed some concern about the stability of the funding for the ISB and, the knock-on impact to their ability to produce high-quality standards and everything else. So I would just say, pretty interesting. Watch this space for further developments.
And I think, look, my takeaway on all this, right, is like, look, we get the nuances of these various accounting and auditing regulators and standard setters, right? And I think our audience typically does not. But I think what it highlights is that what is going on internationally, it's just going to be very different. And the focus of the SEC on really engaging and not necessarily intervening, but having some level of influence on the standard setting, across the globe is going to be there more so than it has been. Definitely. And I think it's not just on the sustainability side, but it's really, to your point, it's on the accounting side, the auditing side. How do we leverage some of the work that others are doing and engage so that we all get to a good place? And look, we all see the benefits of something being a global standard, or if FASB and IFRS, if you've converged a standard, there's some benefits to that, right?
No doubt. I was going to say, the overarching objectives here: one, produce higher quality standards, again, both accounting and auditing, and two, make things simpler for multinational registrants. Yeah. Right. Yep. It's undoubtedly a more complex world where they're dealing with multiple sets of auditing standards and multiple sets of accounting standards.
No, I'm glad you guys had that international flavor in here, because I think it is definitely something to be paying attention to. I want to kind of switch gears a little bit and really talk a little bit about the staff and kind of their work. So we did hear a lot of conversation around, the shutdown. They're digging out of the hole. Certainly heard a lot of insights from kind of how that impacted what Chairman Atkins what they're focused on, timing of things. What we heard from Kurt Hall, CorpFin Chief Accountant Heather Rosenberger. Really very interesting insights. And Kevin, I guess from your perspective, you lived through a shutdown. I'm just wondering, what did you hear? Was it any different from when you were there? But I felt like it was a lot of pressure to dig out, and it took a long time to really get back up to speed. But I gotta believe that people are going to be impacted, and if there's another shutdown, it could get even worse. So you talk about kind of what you heard.
Yeah, right. This was 43 days, right? That's how long it was. And one thing, I definitely felt that the last shutdown that we were both in too, when we were both there, that there was definitely okay, now we got to catch back up. But I think one thing to keep in mind this time is that where the capital markets were this time versus last time, we were already seeing a pretty significant uptick in terms of transactions and things like that before this shutdown, right? And certainly there were a lot of transactions happening the last time too. There's kind of just normal course, but we were seeing kind of an uptick in that anyway. And so this was longer in length, by about 10 days, and then also, right, more filings just in general that came in. So they shared there were in excess of 1,000 registration statements waiting for them to process when they came back.
And to be clear, the staff looks at each one. Right. They may not review it, but even Jim Maloney, the director of CorpFin, said we do screen, which means they take a quick read to see what's in there, what it looks like, to determine the level of review they plan to conduct.
Yeah. And
so it's a lot to get through.
Yeah. Some of that 1,000 may have been ones that had come in before the shutdown, right? That they had started to work on.
That's a great point too. Yeah.
So what they shared is that they're of that population, they're about halfway through in terms of churning through and whether it's doing a screening and deciding not to review it or doing a review and issuing comments. But at the same time, once they reopened, right, people kept filing registration statements. Like I said, it's a busy capital markets. And so those are coming in as well. So we don't know what the incremental additional ones are. They said, consistent with the statement that they released, pretty much immediately when it opened back up, they're processing everything in the order that it came in. I would say anecdotally, that's entirely consistent with what I've seen in terms of ones that I've worked on. But it's just going to take time. They're working very hard to try to get through everything. It just takes time. And I think Jim Maloney did say that he hopes by early next year they'll be back to their kind of normal cadence and their normal time. But like you mentioned, the current funding bill runs out at the end of January, so hopefully that gets resolved and we don't have to worry about this again. But certainly, they're thinking about that and. In terms of the work they're doing, they're focused on the IPOs, right? The capital raising transactions. They did kind of talk about that's really a big area of focus for them. And some of the others, if it's a follow-on offering, resale registration statement, some of those things, they may end up not reviewing it, but it is an important point. They still have to pick it up and look at it and make that decision. So you can't just they kind of reiterate, you can't just file that thing
and immediately
then call
start
the next
looking at
day
it
and say hey,
Yeah.
can you take it effective? Because you're not going to review this. Like he made very clear to say, I'm not saying we're not going to review it. It's just they have a process that they'll have to go through there.
Yeah, and they're not making that choice on the review or no review until they get to its place in the line, right?
Yeah.
So it's not like they're projecting out and saying we don't anticipate.
We talked about that this morning,
Exactly.
right? Like it was, I think it makes sense, right? Like, and that's the way that we would operate when I was there. But I did find it interesting that they did, that they really were saying, hey, look, if you are a new issuer looking to access the capital markets, that's the message. Like that is the priority. And as you said, Kevin, like when we talk about resale registration, so basically, there's a lot of other registration statements that go in. Now, could we see maybe mergers, registration statements, Form S4, whatever? Could we see them getting prioritized to some extent? Maybe, maybe not. I think it probably need to be. It's not going to be prioritized over something as a new capital raise. So I think it's important to think about timing all of that, and then I'd layer on top of that again. If you are going to, if you have a comment letter, you have process, things going on with the SEC today, or let's say you historically go in every year with a waiver of the financial statements for some equity method investee, I think the message is, hey, look, you want a waiver of the rules or some sort of accommodation from the staff, and there are listeners out there that do this and have this issue. Get that in sooner than later, because if you delay, if you wait, if we have another shutdown, you may not have any certainty going into year end, and you may be scrambling trying to figure out, like, do we have to get this audited? How are we going to get this audited? Like, we've not gotten the waiver. We don't have the blessing from the staff. Our circumstances, fact patterns different than last year, so we do feel we need to write in. So, any observations on that or any other things to add? I think that is what we would tell our clients, right?
Yeah. No, I think that's fair.
Okay.
Absolutely.
So you're thinking about just the impact of all of this, right? It's kind of the elephant in the room is these other topics, the rulemaking, right? And you have a chairman that starts very late in the year, builds his team, hires individuals, and the ones that we think about are the Corp Fin director, because that's most impactful to what we do. And that's Jim Maloney. Jim Maloney started pretty much a day before the shutdown or a week before the shutdown. I'm sure they just wanted to get him in. And then, of course, then you have this, this period of time shut down, and they can't work on rulemaking. They can only, as we've heard, it's protection of life and property, which means you're not able to do a whole heck of a lot. So the staff's not working. You kind of don't have the resources to do any work. You have time to think about things, but you got to be very careful about doing anything in the way of rulemaking or other, actions that are outside of what's allowed by the law. Scott, what were your reactions on the discussion surrounding rulemaking? What did you get from the conference?
Well, I guess I would say a couple of things. I mean, certainly, rulemaking, was pretty pervasive again across the conference. I would say that the staff, other than talking about it at the high level, they attempted to avoid talking about any, specific rulemaking initiatives. And so that was kind of interesting to watch them do that dance, over the course of 3 days. But, it was pretty clear that the 43-day shutdown had a meaningful impact on their ability to move things forward. And to some degree, it's a commission that wants to move pretty quickly on some of these rules. And so maybe some degree of frustration with being behind. I would say, we joked on a recent podcast, Kyle, that we got the spring regulatory flex agenda in, I think it was in September. Yeah. And so now we're talking about getting the fall regulatory a little bit closer to the normal calendar. I think that normally comes out in October.
Maybe not. Who knows?
So, I guess we understood from the conference that, the SEC's rulemaking agenda has already been submitted. They're maybe dependent on other agencies because the complete reg flex agenda gets released at one time. Yep. So there were a handful of comments along the way. I think it was Chairman Atkins, who said maybe it was Maloney who said that it would take all of 2026 to get everything they want to do from a rulemaking standpoint, moving. Yeah. But he simultaneously, I would say, maybe put everybody on notice in the room that I think he used his terms. He said fast and furious, right? So he said early 2026. they
they're
expect
going to start seeing some stuff. Yeah,
they expect to start releasing proposals and whatnot. And he sort of urged the room to, one, be ready for that, and two, to be really engaged in that, in those rulemaking processes, right? That the value of the feedback that they collect from everybody in that ecosystem is really critically important to the rulemaking process. I would say, I know I said earlier they all really tried to avoid saying anything specific about individual rulemaking initiatives, but maybe indirectly there were a number of initiatives that were alluded to. There's no real surprises there. So there was quarterly reporting. I know Kevin's going to say a few words about that here in a second. They certainly alluded to what we've talked about again on a prior podcast around how do you draw the line between large registrants and small registrants, right? Yep. And who qualifies and how long do you qualify and what accommodations do you enjoy while you're qualified? Crypto, and that was really similar commentary to what we've seen previously in terms of ending regulation by enforcement, establishing a clear regulatory framework for various market participants to operate within. Executive comp, and then foreign private issuers, which of course we had already gotten a concept release issued on. I had understood from some of the commentary at the conference that maybe the foreign private issuer rulemaking might actually be deprioritized along the way, notwithstanding the fact they got out of the gate first. Right. So all pretty interesting, but again, it's indirect commentary, and we're gleaning things from things that are said along the way.
Well, I think that what it highlights for me is the influence and the impact of the administration, the Trump administration, on their agenda. And so, obviously the some of these topics were pushed, and then it's like, okay, well, and that hits the back burner. And a lot of that may be, hey, we think there are certain things that might be more impactful. I think it's the one thing I'd say is up in the air is whether it be more impactful or not would be Kevin, you're going to talk about next, which is, you think about the cadence of reporting, right? Going from quarterly reporting to semi-annual reporting. I mean, they didn't talk a ton about it, but I mean, anything that you wanted to share on what you heard.
Yeah, no, I mean, I think like literally every single session of the event, right? There was a question in the polling questions asking whoever the speaker was what they thought about it, and from their angle. So it was another one of those pervasive topics. It was obviously top of mind, understandably for everybody in the audience. Maybe we've built this up a little bit. There wasn't a whole lot shared other than it's also top of mind for Paul Atkins and senior leadership of the SEC. It's something that they're thinking about and working through. And so I think reiterating some of their prior messages there. So we didn't really get any specific answers in terms of exactly what that model is. I will say that there was, to me, I thought there was a lot of really good discussion on all sides of the issue. And so I don't know if the SEC can grab recordings of this and that'll feed into like as they think about what that proposal looks like, right? Like it's and a lot of it, probably isn't different from the prior request for comment. But it's certainly something and as you mentioned, Scott, like, definitely going to see stuff in 2026. And so, I think this will be on that list as well. And I think a lot of people are really anxious to kind of see what the model is that the SEC comes out with in the proposal.
Yeah. So speaking of 2026, as many companies are now heading into year end, and of course engagement teams, our folks that are listening, and maybe I'm sure our competitors are also listening because the quality of you guys, my guests are amazing. What are a few of the kind of key takeaways or reminders for folks out there listening?
Yeah, I mean, I think one of the things we heard from Corp Fin, an area of interest, right, was around the disclosures on segment, right? And we saw this last year was a new standard. All right, how did everybody adopt? Now we have the benefit of seeing across the landscape. So we did get some observations from the staff. I think one observation I had was that a lot of their observations were the same as the observations that Kyle, you and me, and Jay Celeber had in our podcast that came out recently as well. So I won't repeat those here, but a lot of the compliance type of things, they, obviously segments is a very important disclosure area, and the staff kind of always is reiterating points on that. They talked about some of the challenges with determining the required measure, especially, as CODMs will often get maybe different types of information and more than one measure of profitability that they use. So they talked about some of the nuances in that, but also the importance of getting that required measure right. And then another area was the single segment, some of the pitfalls there that they've seen in disclosures from single segments that, you can't just say, well, we're a single operating segment, and so therefore just look at the consolidated statements. There's incremental disclosures that would be required regardless, and also questions around, well, what are the significant expenses there? And then they reiterated, and again, I think we had all these points in the podcast too, but the other podcast about subtotals and some of the formatting and table. So
I was happy to know that the podcast that we did publish the same day, we published it the same day and we recorded it earlier, that was spot on with what the staff said and their observations, right?
Jay and I were actually talking and we were sweating a little bit.
Goodness.
It was good to hear that. Maybe along the same line of consistent themes, because we are in the midst of the comment letter themes podcast. MD&A was another, right? Just constantly thinking about it. You mentioned tariffs earlier. I think that's kind of like a big point, right? As people think about, well, how are those tariffs impacting the business? And so I know we talk a lot about MD&A considerations, uncertainties, right? That could have a material impact. And so they reiterated some of those. Non-GAAP, another one, right? Top of mind for everybody. So, I don't think, I wouldn't say that anything that they said at the conference relating to non-GAAP was really any different from what they've said in the past or any real change in tune. But I think it just highlights that it's something that they spend a lot of time on. And so I think good information.
Scott, anything you wanted to add there?
Yeah, I had just a couple of the things that, they highlighted that are really also, just application of existing guidance, I would say, but they called it out as, specificness that they're seeing, which are maybe relevant for registrants going into year end. So the first was in relation to the statement of cash flows and, ensuring that, the captions and the disaggregation that you're showing on the face of the statement of cash flows is sufficiently detailed, breaks out any material components of the cash flows. The example that they specifically cited was in relation to operating activities and disaggregating changes in receivables, payables, and inventory to present those separately. They highlighted the need for non-SRC registrants under 408 to disclose material related party transactions on the face.
So that's Rule 408 of Regulation SK.
Exactly. Yep. Thank you.
SX. Sorry.
SX. Yeah. So on the face of the primary financial statements, that's a good reminder for registrants going into year end. And then they reminded registrants of the need, to disaggregate when you exceed certain quantitative thresholds to report revenue from tangible goods and services separately, again, on the face of the income statement, to do the same for the related cost of goods sold or services. And I would just say, on that one, it's maybe like some other things where, they stress the need to continuously reevaluate those numerical thresholds. So you might have disproportionate growth in different areas of your business that cause you to exceed a quantitative threshold. Certainly seen situations in the past where registrants get caught off guard late in the year when they have M&A related activity. They divest of something that is classified as a discontinued operation, and all of a sudden, you exceed a numerical threshold. So that was another, I think, a good reminder that the staff put out there for registrants in relation to year end.
One of the things that stood out to me on that point, right, as you said, is our listeners need to be thinking about what has happened to the business over the course of the year, and set aside what you've been doing quarterly, right? But we're thinking about the staff is going to pick up your 10K for review. They're going to have certain expectations. They're going to understand what you've done, where you've been, like you've had mergers, you've had changes in the business. And it not only just the impact across the filing, right? Thinking about, and we heard this on segments, right, is, hey, you got to be thinking about that because, with the economics, we think about tariffs. We've already talked about that, right? You have tariffs that are impacting your segment analysis potentially. So you need to you can't just, rinse and repeat and just throw in the same disclosures or say you have to always reevaluate and revisit these disclosures.
Yeah, they did call that one as well, right? In terms of just the economics, right? In this environment, it's pretty volatile, and the economics of, individual operating segments may diverge as a result of, the economy impacting them in different ways, diverge in a way that perhaps they don't meet the aggregation criteria any longer to be reported as a single reportable segment. So another good reminder.
All right, let's jump right over to OCA and the FASB, and I guess I'll start maybe Scott with you, kind of get your thoughts, anything that you wanted to highlight beyond kind of some of what we've been covering already.
Yeah, I think we're going to do this at a pretty cursory level, but just to say a couple of words about some of the topics that OCA hits. So one of them was certainly fair value. It's been a recurring theme over the past several years. We hear about it almost every year. If I take a step back, it's just an area of a lot of judgment, right? And so where there's a lot of judgment, there's estimates involved, and it's always going to be a focus of the SEC staff. I would say I distilled it down into really three things that they hit this year at a high level. One was the involvement of appropriate specialists. And interestingly, they called out the fact that, valuation specialists are not fungible. Mm-hmm. Somebody who's specialized in the valuation of financial instruments, is totally different skill set than someone who deals with fixed assets or intangibles or something like this. They again articulated this concept of calibration, which they've hit over the past couple of years, which is this idea that your current model, if it uses inputs, if you change your model over time, you ought to generate, consistent results. You shouldn't have, essentially differentials being generated from altering models. And then, and again, I think this is a consistent theme, but this idea that, you should have into valuation models, you should have consistent inputs across your organization. So when you think about goodwill impairment, how do those cash flow forecasts match up with what you use for deferred tax valuation allowances, for example, right? And being consistent across the organization.
Yeah, that's great points. Kevin?
Yeah, I mean, as I preparing for the conference, I saw on the agenda that John Dersch was going to be speaking, and Kyle, you and I worked with John for many years, and he's a great guy. But I was like, we know what's coming. We're definitely going to hear something about an oil and gas type of issue, and either debt and equity or derivatives. He didn't disappoint. So he definitely he talked about among some other things. One, he talked about a derivative issue, particularly around normal purchase, normal sale, the scope exception there. And so those things, right, very nuanced fact patterns and very specific. So won't get into the details there, but I think just a helpful discussion of how they thought through an issue in particular, which I think was good. And I'm sure like our publication will have all the specific details.
Yeah, our written publication that we put out, right? I think that's always kind of a nice treasure trove of details on some of these nuances, right? I think there were a lot, and there's a lot that was said that I think some people might look and say, that's pretty in the weeds. We certainly don't want to talk about it on the podcast because we probably won't be able to follow it. but I think it's, be on the lookout for that. Anything else, or we can move to the final item, I think, which is you, Scott, and kind of want to get your reaction to kind of what we heard from whether from the PCAOB or related to the PCAOB from the SEC, who obviously exercises oversight of the PCAOB, and anything that you want to quickly touch on.
Yeah, I'll do this very quickly. Well, I'll try to do it very quickly. Sometimes I struggle with that. So
me too.
I'll attempt to do this very quickly. And we won't go into, what various, staff members of the PCAOB actually said at a more tactical level, just maybe hit environmental conditions. So certainly the SEC reaffirmed their intent to exercise oversight over the PCAOB. You may recall in connection with the One Big Beautiful Bill Act, there was initially some provisions in there that might have, sort of collapsed the PCAOB down into the SEC. So there were questions about whether the PCAOB's mandate would be rescinded. And I think Kurt Hole, in response to perhaps a question along those lines, quickly disposed with it. And he said, it's going to require an act of Congress. I think he said that's not going to happen, although this is a crazy town, so you never know. Okay, but I think the PCAOB will continue to exist, and various people. It may have been Chairman Atkins, who reinforced the importance of the PCAOB and their role in this ecosystem. So again, Kurt was he went a bit deeper on his commentary, and he highlighted a few focus areas. I would just say on inspections, there was some discussion about focusing on firm level systems of quality management versus engagement level inspections, maybe severity ratings for inspection results, et cetera. He talked about a possible pre-clearance type process similar to what we do frequently with the SEC. Would that be something that
with respect to like the accounting issues,
the auditing issues?
But they you do the pre-clear for the accounting, and then you also can pre-clear for reporting issues. But hey, it would be great if you could pre-clear for auditing, right? Exactly. So that was a theme of Kurt's commentary. And then from a standard setting standpoint, he talked a little bit about maybe there's benefit to doing an agenda consultation similar to what the FASB does. Again, this theme of convergence that we talked about earlier sort of pervaded the conference. So, so some interesting commentary there. Yeah, and look, as we've been hearing, we heard throughout the conference, they really encourage to reach out to the staff, participate in roundtables, respond to requests for comments on these proposals or even concept releases. You can engage with the SEC, the FASB, and the PCAOB. So I think if, I always say, like, don't complain about it. Like you can, after the fact, complain about it before you can get in during the comment letter process. I also want to encourage our audience to listen to some of the other podcasts that we've mentioned, and of course, read our in-depth for a deeper dive on these topics and other technical topics discussed at the conference. But I want to thank the two of you today for joining me. And not only is it great that you joined me today, we've had a very long week. I want to thank you kind of for, sticking with it from Sunday through now today. Thank you so much for joining.
Thanks. Happy to do it. Thank you.
Appreciate it.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.